Sufficient appropriate audit evidence for verifying the existence and condition of the inventory when inventory is material to the financial statement. Various possibility. First is, if physical inventory counting is conducted at a date, it means for example 31st March is not possible and verification is scheduled on 25th March, then perform the e-topic which we already revised previously. Perform the e-topic procedure and reconciliation for the changes between the count date and the date of the financial statement. Whatever the adjustment made difference, if any, reconcile it. Second possibility, if the auditor is unable to attend unable to attend the physical inventory counting due to unforeseen circumstances. For example, management is ready but audit team was not able to visit as on the planned date due to some unexpected situation. So what procedure need to be performed? Some physical count as on the alternative date plus perform the audit procedure on intervening transaction, reconciliation plus obtained a written representation from management that all the standard procedure were followed for counting and they have informed the auditor about the differences, if any. And the third possibility is, it is if the attendance at a physical inventory counting is not possible or impossible to attend. For example, location is near border areas and currently there are disturbances making it impossible to conduct the inventory count. So what procedure need to be performed to obtain the sufficient appropriate audit evidence is to perform the alternate audit procedure. It means verify the previous record, legis scrutiny, and conduct the reconciliation till the count date and read the internal auditor or other auditor report, etc. If it does not provide sufficient appropriate audit evidence, then modify the opinion as per SA 705. Okay. Existence and condition of the inventories. Matter relevant in planning attendance at a physical inventory counting. Memory technique is win letter. Work in progress determining the completion of the inventory, internal controls for maintenance of the inventory, nature of the inventory, location at which the inventory is held, adequate procedure for adequate procedure established by the management, arrangement made by them for the inventory count, timing of the count, experts assistant is required, and risk of material misstatement is involved. So these are the matters which need to be considered in planning the attendance at a physical inventory counting. Next is sufficient appropriate audit evidence for verifying the completeness of the litigation and claims. This is the second part which is started. This one. This part is completed. Now we are going with the completeness of the litigation and claim. Detail. Completeness of the litigation and claim. Memory word is I am crew. You can say I am crew. Inquiring the entity in-house legal counsel about the litigation and claim. Inquiring the in-house legal counsel about the litigation and claim involving the entity. Inquiring the management about the litigation and claims involving the entity. Inquiring management. First is in-house legal counsel, second is management. Communication between the entity and its external legal counsel should be verified. reviewing the legal expense account for the entity to identify the litigation and claim, and external confirmation from the entity's external legal counsel. मतलब management should be asked to allow the external legal counsel to communicate with the auditor. There are two possibilities. If management refuse, then consider the impact on opinion as per SA 705 modified opinion, and if management allow but lawyer does not respond, then perform alternate audit procedure. If sufficient appropriate audit evidence still not available, then consider the impact on opinion as per SA 705. Written representation from the management as per SA 580 regarding the completeness, no omission of the litigation and claim involving the entity needs to be obtained, and presentation and disclosure in the financial statement about the litigation and claims involving the entity as per applicable financial reporting framework. Sufficient appropriate audit evidence for verifying the completeness of the litigation and claim. Examples of the circumstances when auditor may seek a meeting with the entity's external legal counsel. The auditor determined the matter is a significant risk, the matter is complex, and there is a disagreement between the management and the entity's external legal counsel. Ordinarily, such meetings required management's permission and are held with a representative of the management in attendance. Sufficient appropriate audit evidence for verifying the presentation and disclosure of the segment information. Now this is the third part which started. Presentation and disclosure. First is obtaining an understanding of the methods used by the management in determining a segment information, whether such method provide a fair presentation as per applicable financial reporting framework, and test the application of such method. For example, sale, transfer, and the charges between the segment and elimination of the intersegment amount is as per accounting standard 17 or not. You have to check it. Comparison with the budget and other expected result. For example, operating profit as a percentage of the sales, allocation of the asset and the cost among the segments, and consistency with the prior period, and the adequacy of the disclosure with the respect to inconsistencies. First is the understanding of the method. Now second is to perform the analytical procedure, ratio comparison as per SA 520. Analytical procedure. Here all the 3 points got completed. Now the next essay is essay 510, initial audit engagement, verification of the opening balance. Initial audit engagement, an engagement in which either the financial statement for the prior period were not audited, or the financial statement for the period for the prior period were audited by the predecessor auditor. Opening balance. Account balance that exists at the beginning of the period, it means prior period closing balance, plus the matters requiring disclosure that existed at the beginning of the period, such as contingencies and commitment of the prior period. What is the objective of this essay 510? Objective is to obtain sufficient appropriate audit evidence about whether opening balances contain a misstatement that materially affect the current period's financial statement, and accounting policies reflected in the opening balances are appropriate as per applicable financial reporting framework, consistently applied, and if there is any changes, those changes are properly accounted, presented, and disclosed as per the applicable financial reporting framework. Essay 520, initial audit engagement, verification of the opening balance. The most recent financial statement, if any, and the predecessor auditor's report, if any, Whether prior period balance have been correctly brought forward, you have to check, and any adjustment to the opening balance disclose as prior period item in the current year P&L. Verify whether the accounting policies are appropriate as per applicable financial reporting framework, consistently applied, and if any changes then have been properly accounted, presented, and disclosed in the financial statement as per applicable financial reporting framework. This is the same summary of which we have revised earlier. This is in detail, and this is just a summary chart. Memory technique, read forward, adjustment policy. So you have to keep in mind this word, read forward, adjustment, and policies, for to revise all this thing. Use of the predecessor auditor's report. While performing risk assessment procedure, if predecessor auditor has expressed modified opinion on the prior period financial statement, that it helps the auditor to understand the risk of material misstatement in the current financial period. And while performing the audit conclusions, modified opinion are expressed by the predecessor auditor on the prior period financial statement, matter has been resolved in a current year financial statement, and matter remains unresolved in current year financial statement, matter remains relevant and material in current year financial statement, then modify the opinion in current year financial statement. These are the points which need to be taken care of. The next is various possibilities for the accounting conclusions. The first is, if the auditor is unable to obtain sufficient appropriate audit evidence regarding the opening balance, then qualified or a disclaimer opinion. Why? Because the auditor is unable to obtain sufficient appropriate evidence, and we don't know whether it is a material or not. Those evidence which will be obtained. Next is, the auditor conclude that opening balance contained a misstatement that materially affect the current period financial statement, and the effect of misstatement is not properly accounted for or not adequately presented or disclosed. Now it shows that the evidence which obtained is material, but it is not pervasive, so it can be a qualified or an adverse opinion. I'm so sorry. Wait. Uh, it's actually wrong. I apologize for this thing. I just forgot that this is a part of exercise, and in that uh, we have to give a correct answer regarding that. This is not answer itself. These are the options which is given. We'll do this exercise later on. The next essay is essay 550, related party transactions. So the definition is, as defined in the applicable financial reporting framework and accounting standard 18 and Ind AS 24. If applicable financial reporting framework is silent, then following relationship will be considered as the related parties: a person or other entity that has a control or a significant influence directly or indirectly through one or more intermediaries or over the reporting entity uh, reporting entity means the entity which is being audited, right? Let's understand. X is a person or other entity. Y is an intermediary. Z is a Z is a reporting entity being audited. In the above diagram, X, Y, Z are related parties. For definition of the control and significant influence, refer Accounting Standard 18 and Index 24, right? Another entity over which the reporting entity has a control or a significant influence directly or indirectly through one or more intermediaries. Q is a person or other entity. P is intermediary and Z is a reporting entity. In the above diagram, Z, P, Q are related party. For the definition of the control and significant influence, these are all related party transactions will be considered. That point was just for understanding, which we have already understood what are the related party transactions thoroughly while we were studying. This is just a revision so we can recall it. No need to explain that particular thing here. And the third is another entity that is under a common control with the reporting entity through having a common controlling ownership or owners who are close family members or a common key management, right? Exception is a government entity. Now, what are the exceptions to related party transaction is government control entities. However, entities that are under a common control by a state, national, regional, or a local government are not considered related unless they are engaged in a significant transaction or share resources to a significant extent with one another. Okay. Otherwise, likewise, if we see, then every government owned entity is a related party to one another. So that's not be possible now. If there is a significant transaction, then only it will be applied to government control entities. The next is objective of the auditor. What is the objective of the auditor in related party transaction? Is perform risk assessment procedure for identifying risk of material misstatement due to fraud. What can go wrong in a financial statement due to related party transactions or related party relationship. Perform further audit procedure to obtain sufficient appropriate audit evidence whether the related party relationship and related party transaction have been appropriately identified, accounted, and disclosed in the financial statement as a per applicable financial reporting framework. And to conclude, the objective first is to perform the risk assessment procedure, then second is to perform the further audit procedure, the third is to conclude whether the related party relationship and related party transaction in financial statement achieve a true and fair view and not misleading. Related party relationship and related party transaction can lead to high risk of material misstatement than other transaction, and the examples are related parties may operate through an extensive and complex range of relationship and structure with a corresponding increase in the complexity of the related party transaction. Related party transactions may not be conducted under a normal market terms and a condition. For example, some related party transaction may be conducted with no exchange of consideration. An information system may be ineffective at identifying or summarizing the transaction and outstanding balances between an entity and its related parties. The next is risk assessment procedure, obtaining an understanding with reference to related party relationship and related party transaction. The risk assessment procedure is understanding the entity's related party relationship and related party transaction, conduct inquiry of the management regarding identity of entities related parties, change from prior period, nature of the entities related party relationship, type and purpose of the transaction. How to evaluate the internal controls over the entities, RPR and RPT. How entity identifies, account for and discloses the related party relationship and related party transactions in financial statement. Who authorizes and approve the significant arrangement with the related parties, and who authorizes and approves the significant transaction with the related party, including the transactions outside the normal course of business. So all these things need to be considered for the evaluation of the internal controls. Now, identifying the related party, identifying the related parties, where the applicable financial reporting framework establish a related party requirement. Information regarding the identity of the entity's related party is likely to be readily available to management, because the entity's information system will need to record the process and summarize the related party relationship and the transactions. Where applicable, financial reporting framework does not establish a related party requirement, auditors shall still conduct the following inquiries: the entity's ownership and governance structure, the type of the investment that entity is making and plan to make in related parties business, and the way entity is structured and how it is financed. Identification. Identification of previously unidentified or undisclosed related parties or significant related party transactions. For examples of the records or document which can show the existence of the related party transactions or relationship which may not have been previously identified are the income tax return, internal auditors report of the entity's investment, information supplied by the entity to regulatory authorities, significant contract and agreement not in the entity's ordinary course of business, and shareholder registered. This is the memory technique you can use it.